Welcome back to the Daily Crypto Deep Dive. Today's episode is about Michael Saylor's strategy and the 32 Bitcoin sale that has suddenly become one of the most talked about stories in crypto. And let's be clear from the start, this was not a massive Bitcoin dump. Strategy did not sell billions of dollars worth of Bitcoin. Michael Saylor has not walked away from the Bitcoin thesis. The company still holds more than 843,000 Bitcoin, making it by far the largest publicly traded corporate Bitcoin holder in the world. But the reason this story matters is not the size of the sale. It is the symbolism. Because for years, the Michael Saylor story has been simple. Buy Bitcoin. Hold Bitcoin. Never sell Bitcoin. Use the capital markets to acquire more Bitcoin. Turn strategy into the ultimate corporate Bitcoin vehicle. That was the clean narrative. But now that narrative has become more complicated. And before we get into the details, a quick word on Kraken. If you are building your crypto portfolio for the long term, make sure you are using a serious platform. Our Kraken link is in the description, and if you sign up through our link, we are giving away 20 XRP to qualifying listeners. As always, only invest what you can afford to hold through volatility, and always think long term. Now let's get into the story. Strategy sold 32 Bitcoin between May 26th and May 31st, raising roughly $2.5 million. The sale was done at an average net price of around $77,135 per coin. In pure balance sheet terms, that is tiny, almost meaningless. It represented less than 1/100% of Strategy's Bitcoin stack. So the first reaction many people had was obvious. Why bother? If the sale is so small, why do it at all? That is the real question. Because when a company with over 843,000 Bitcoin sells just 32 Bitcoin, it is not really about raising money in the normal sense. Strategy is not suddenly cashing out. It is not abandoning the Bitcoin treasury model. It is not trying to reduce exposure in any meaningful way. What it appears to be doing is sending a message. And the message is this. Strategy's Bitcoin pile is no longer just a sacred holding. It is also a financial asset inside a much bigger capital markets machine. That is the part investors need to understand. Strategy is not the same company it was in 2020, 2021, or even 2022. Back then, the story was simpler. It was a software company that decided to hold Bitcoin as a treasury reserve asset. Then it became a company using debt and equity to buy more Bitcoin. Then it became a kind of public market Bitcoin proxy. Now it has evolved again. Today, Strategy has common stock, convertible debt, preferred stock, dividend obligations, cash reserves, and a massive Bitcoin balance sheet sitting behind it all. This is not just a Bitcoin holding company anymore. It is a Bitcoin-backed financial engineering company. And that is why this small sale has caused such a big debate. Michael Saylor's first public comment after the sale was not really about the sale itself. He posted that Strategy's goal is to make STRC, its stretch preferred stock, the best credit instrument in the world. That wording matters, because the focus was not, don't worry, we still love Bitcoin. The focus was the preferred stock, the credit instrument, the capital structure. And that tells us where Strategy is now trying to go. It is trying to turn Bitcoin into the foundation for a new kind of corporate credit product. It is not just saying Bitcoin is digital gold. It is saying Bitcoin can support engineered yield products, preferred shares, capital raises, and long-term shareholder value. That sounds exciting, but it also introduces new pressure. Because preferred stock has dividend expectations. Credit investors want payments. Capital markets want confidence. If Strategy raises money through these instruments, it has to maintain trust not only with Bitcoin believers, but also with stockholders, preferred shareholders, and creditors. That is why the 32 Bitcoin sale matters. It suggests that when the company has a payment obligation, it may sell a small amount of Bitcoin if that is the most efficient way to handle the obligation. And that is where the analysts split. TD Cowen analyst Lance Vitanza said the headlines suggesting Strategy had meaningfully reduced its Bitcoin position were misleading. His view is that the transaction was economically immaterial and does not change the core accumulation thesis. And on the numbers, he is right. If you own more than 843,000 Bitcoin and you sell 32, you have not changed your Bitcoin exposure in any serious way. You are still overwhelmingly a Bitcoin company. You are still tied to Bitcoin's long-term performance. You are still structurally bullish on Bitcoin. Benchmark analyst Mark Palmer made a similar point. He does not expect Strategy to use Bitcoin sales as the main way to pay dividends. His view is that Strategy is more likely to replenish its cash reserve through equity issuance than use that reserve to fund preferred stock payments. That would make this more of a tactical treasury move than a major strategic shift. But Palmer also made a very important point. He said investors should now view Strategy's Bitcoin holdings as a viable backstop for preferred dividends. That is the key phrase. A viable backstop. In plain English, that means the Bitcoin pile is not untouchable. It can be used if needed. That does not mean Strategy is going to start dumping Bitcoin every week, but it does mean the market now has to think about the Bitcoin holdings differently. Before, the assumption was, Strategy buys and holds. Now the assumption may become, Strategy buys, holds, and occasionally sells small amounts when it helps protect the wider capital structure. That is a meaningful change. Risk Dimension's Chief Investment Officer Mark Connors went further. He argued that by selling Bitcoin, Saylor has shown two things. First, that Strategy will support shareholders and creditors in every way, including by selling Bitcoin. Second, that Strategy has prioritized the health and perception of the capital structure over being a pure diamond-handed Bitcoin holder. That is the uncomfortable part for some Bitcoin purists, because Bitcoin culture loves purity. It loves the idea of never selling. It loves conviction. It loves the almost religious discipline of holding through every cycle. But public companies do not operate purely on ideology. They operate through balance sheets, debt markets, dividend schedules, shareholder expectations, and legal obligations. And that is where Strategy is now living. This is why we can say we have been warning that something like this could happen for a while. Not because Saylor suddenly turned bearish, not because Bitcoin is finished, but because once a company builds a complex financial structure around Bitcoin, there may come a point where selling a small amount of Bitcoin is not betrayal. It is treasury management. And that is exactly what seems to have happened here. Now, was Strategy out of cash? At the end of the first quarter, Strategy had about $2.21 billion in cash and cash equivalents. So this was not a company with $0 in the bank being forced into an emergency sale. But the picture changed through May. Strategy had recently repurchased $1.5 billion of convertible debt, and according to CoinDesk, it then rebuilt its dollar cash reserve from $871 million to $900 million. That tells us the company is actively managing liquidity, debt, preferred dividends, and Bitcoin exposure all at once. So the right question is not, did Strategy have absolutely no cash? The better question is, was selling 32 Bitcoin more efficient than issuing more equity, raising more preferred stock, or reducing cash reserves further? And based on the way management has been talking, that is likely the answer. Strategy has repeatedly framed its decisions through the idea of increasing Bitcoin per share. That means management is not simply asking, how do we hold the most Bitcoin in total? It is asking, how do we maximize Bitcoin exposure for each shareholder over time? That is a different calculation. Sometimes issuing equity can help buy more Bitcoin without hurting the per-share math. Sometimes issuing preferred stock can bring in capital. Sometimes using cash reserves is best. And sometimes, if the company believes selling a tiny amount of Bitcoin is more accretive than diluting shareholders, it may choose the sale. This is the phrase listeners need to understand: math over ideology. Strategy may still be ideologically bullish on Bitcoin, but the machine is now being run through financial math. And that is probably why the sale was so small. If Strategy wanted to signal that Bitcoin sales are possible without creating panic, 32 Bitcoin is almost the smallest possible meaningful test. It is big enough to disclose. It is big enough to show the mechanism works. But it is small enough to say, this does not change the Bitcoin thesis. In other words, this may have been an inoculation sale. Saylor had already hinted at this kind of possibility. He had said it was not unlikely that Strategy could sell some Bitcoin before the end of the year. That alone was a major softening from the old never sell posture. So we should not treat this as coming out of nowhere. The market had warning signs. There were comments from Saylor. There were comments from management. There was discussion around preferred dividends. There was the reality that Bitcoin itself does not produce cash flow. There was the fact that Strategy has created a large dividend-paying capital structure around a non-yielding asset. That is the tension at the center of the whole story. Bitcoin may go up over time, but Bitcoin does not pay coupons. It does not send interest payments. It does not automatically fund dividends. So if Strategy creates instruments that require payouts, those payouts have to come from somewhere. They can come from cash reserves. They can come from issuing shares. They can come from issuing more preferred stock. They can come from the software business, though that business is much too small to fund the whole machine on its own. Or they can occasionally come from Bitcoin sales. That is the financial reality. And this is why the story is so entertaining for the market, because it exposes the gap between the meme and the machine. The meme is, Saylor never sells. The machine is, Strategy optimizes capital allocation to increase Bitcoin per share and protect its financial structure. Those are not always the same thing. Now, is this the start of Saylor selling full-time? Based on the facts available right now, no. There's no evidence that Strategy is beginning a major liquidation. The sale was tiny. Analysts broadly agree it was immaterial. Strategy still holds a gigantic Bitcoin position. And the company's broader strategy still appears to be accumulation over the long term. But is this likely to be the only sale ever? That is also unlikely. Once the company has crossed this line, future small sales become easier to justify. If Bitcoin sales can be used selectively to pay dividends, improve capital efficiency, avoid worse dilution, or manage liquidity, then it would be naive to assume this will never happen again. The better forecast is this. Strategy will probably remain a long-term Bitcoin accumulator, but with more flexible treasury management than the old narrative suggested. That is not necessarily bearish. In fact, if done carefully, it could make Strategy more durable. A company that can use all available tools, equity, credit, cash, and tiny Bitcoin sales, may be more resilient than a company that locks itself into a slogan. But it does change the emotional story. And crypto trades on emotional stories. That is why Bitcoin dipped. That is why Strategy stock dropped. That is why people panicked. That is why Polymarket exploded into a dispute. The Polymarket angle is fascinating. A market asking whether Strategy would sell Bitcoin by May 31st became disputed because the sale happened between May 26th and May 31st. But the filing came out on June 1st. Yes, bettors argue the sale occurred before the deadline. No bettors argue the public disclosure happened after the deadline. Millions of dollars are now tied up in a technical fight over what date counts. That tells you how closely the market was watching this. This was not just a company filing. It was a live test of one of crypto's biggest narratives. So where do we land? Here's the balanced view. This sale does not mean Michael Saylor has turned bearish on Bitcoin. It does not mean Strategy is dumping. It does not mean the Bitcoin treasury model is broken. But it does mean the simple never sell story is over. Strategy is now a more complex creature. It is part Bitcoin holder, part capital markets machine, part preferred stock issuer, part software company, and part experiment in Bitcoin-backed corporate finance. And that is why this small 32 Bitcoin sale may end up being one of the most important signals of the year. Drop your thoughts in the comments, smash like, follow, and as always, we will see you at the top.